let's shift focus to Samvardhana Motherson, where the company has now completed its 6,637 crore QIP. The issue saw strong demand and shares were issued at 190 rupees a share against the floor price of 188. Now, as we spoke to the management of Samvardhana Motherson, Kunal Malani, who is the CFO of Samvardhana Motherson, to understand as to what the fundraise is all about and the outlook of the company. Listen in.
Look, I think we've been inundated with opportunities right now. Right, if you think from an automotive space, the reality is there are some pain in the Western world. The supply chain is stressed, and we do anticipate a lot more opportunities to come in it. As you know, in chaos lies the opportunity. When you think from a non-automotive space, we are very uniquely positioned to be a manufacturing powerhouse. It's been highlighted as as a validation when we started a consumer electronics business. The aerospace business, where we have just completed ADI Industries and makes us a global player in the aerospace industries, and we do anticipate a lot more opportunities to also come in there. Our health and medical new unit the joint venture with Iriliac, the new product there is going to get launched in October. Our new facility is kickstarting from next quarter onwards. So overall, again, positioned for incremental growth opportunities to come in. Now, with all of these, as an example, coming all pretty much parallelly at the same time, it has resulted in, we having to make a choice among some of these opportunities. And hence our thought was, instead of making a choice, let's fortify the balance sheet, which is what the capital raise does. And hence we are then in a capacity to actually go after all of them pretty much parallelly. This will make sure that we are catering to all the different consumer sets that are there. And it'll also make sure that we can actually do a lot more with our balance sheet than what it was earlier. So while in the intermediate, we will end up paying down the debt, as you rightly mentioned. But going forward, we do anticipate many of these opportunities to kick in, and thereby we'll again lever it up again and add to our business perimeter that exists.
Just a follow-up on that, Mr. Malani. Now, you mentioned in a previous conversation, after the first quarter results, that you want to decrease your net debt to EBITDA to 1 versus just 1.5 times that it was. Now, with this fundraise, you will be able to do that. But as you rightly said, there will be a lot of opportunity in the newer spaces as well, apart from automotive, that you will be going after against in case the opportunity persists. Do you have a target for the net debt to EBITDA ratio, or do you feel that it's imperative to keep it between 1 to 1.5, depending on the business opportunity that comes in?
So, look, our financial policy, and that is publicly stated, is 2.5 times net debt to EBITDA. And if we were to ever exceed that, then within 12-month time period, we need a clear line of sight to bring it down below 2.5. The fact is, we have never actually exceeded that. So that just highlights the discipline. We've been an acquisitive entity. And if you look at it over even the last 1 decade, we may have done 30 plus acquisitions. We've never exceeded, in fact, the number 1.5 itself. So 1.5 to 2 has been our comfort level. And that is something we intend to achieve. Obviously, in different points in time, things may play out differently, given some of these opportunities can be lumpy in nature. But our objective will always be to be in and around that 1.5 to 2x. That's our comfort level, with our financial policy being at 2.5. Now, it is also important that this is there because the customer also sees it, and ours is a reactive strategy. As you know, while we are acquisitive, it is not that we are deciding what to acquire. We let the customers tell us what is potentially good for us and where we can add value. And in that reaction that we need to get, he obviously looks at our balance sheet to make sure that it is there for whichever opportunity he's providing us. So hence, keeping that a strong, healthy balance sheet just makes sure we are getting to know about these opportunities. Had it not been, we may not even hear about these opportunities. And hence the importance of keeping the financial discipline in place.
Now, before I come to the business outlook, just one question on acquisitions, because over the last few years, we have seen, as you mentioned, that customers do come up to you for these opportunities, and that's when the decisions are made. But now you are entering also into a non-automotive side of business, as you mentioned, aerospace, healthcare. What is the strategy there for acquisitions? How are you tackling these, and how are you coming across them as well? And specifically, do you have any outlook for these specific non-auto businesses that they have to be outside India or within India, something on that? And what's the current revenue picture from them, from the new non-auto business currently? Are they more India-centric? If you could just give us some light on that.
No, look, our strategy is exactly the same as what we have in automotive. If you look at automotive, we started with Sumitomo-san, we learned wiring harness, then we got more opportunities, more joint ventures, we went global with it, and we are where we are in this journey right now. If you look at our non-automotive, the playbook is exactly the same. If you look at aerospace, for example, we started the team in 16. We did small things with the customer to get them comfortable. They then helped us look at, creating a joint venture with Sim Tools. A couple of years later, while Sim Tool has grown nearly 35-40% CAGR, we are now just acquired ADI Industries, which takes this business global. And thereon, I'm presuming as we do well with that, there'll be more opportunities. Same story when you look at health and medical. We have created the joint venture with Iriliac. Now our greenfield facility should be up and running. Logistics, same story, Hamicorex joint venture. And we're trying to do optimization of our own internal logistics and so on and so forth. So the playbook is exactly the same. It's a successful formula that has worked for us. So really no need to change. And it's still a reactive strategy, even from an acquisition perspective. So all in all, it's exactly the way we've done in automotive. We're just doing that for other industry sets.
Now, just one question on the business outlook per se, because we have seen that auto companies have come out and sounded off alarms, as well as some of them have actually cut guidance, the likes of BMW. Now, you also cater to that region, but specifically, I just wanted to ask, because in your quarter four presentation, you did call out that BMW forms about 5% of your current revenue. How are you seeing the impact of BMW specifically cutting their guidance for this particular fiscal year? And because we have seen a lot of problems are coming from China specifically, where auto components, Indian auto companies makers are not big, because there is a lot of focus on Europe as well as the USA. So how does that, just a two-part question on this, how is BMW's guidance cut specifically impacts you, because it's a sizable number? And secondly, on the business outlook itself.
Look, for the first one, again, to be seen how BMW plays out. But if you look at our revenue share, which is around about, if I remember, around about 4% you can take a 10-15% haircut. So you can imagine the impact. It is less than a percentage on our top line in that regard. And that's the beauty of the 3CX10 that we have followed. No country, no component, no customer should be more than 10% of our sales. So reality is something or the other will keep happening across the world. And in our diversity, it gets fairly muted out. And that's the benefit of the diversity that we have. We'll, however, work with the customers to try and find solutions. That's a different matter. But in the extreme short term, the implications become muted out. You're right that the industry in general is challenged, especially in the western part of the world. Having said so, again, we have multitude of different factors that in some way negated. A lot of you see is getting impacted by EV volumes, getting into the zone of flattish growth or low growth, and that is not playing out in terms of the incremental volumes that were expected to come out of it. At the same time, we are seeing ICE actually getting elongated. So for a player like us, which is powertrain agnostic, the reality is, while one part of the business may have an implication because we do have EV orders as well, we are also seeing extension of ICE orders, which then is ROC accretive for us. If you think from premiumization trends, and all our product categories get benefited by premiumization trends because it carries more content. The reality is, again, that trend seems to continue irrespective, and hence should not be having as much of an impact. So our content growth should continue to grow. Also, if you look at Western world, I mean, it's been 10-15% lower than pre-COVID levels for a fair amount of time now. And hence there is a base level of demand which will likely exist. And hence we do not anticipate a cliff kind of an environment. It is more of a muted growth, maybe plus minus 2% is the way we see that part of the world play out. On the China front, I think while there are challenges that are there, and there's a lot more with the international OEM than with the Chinese OEMs, We do service all of them, though in a very small way to the Chinese OEMs. And as and when they were to move into the offshore part, I mean, outside China, that's the time we will tap into them in a much larger way than where it is today. India, while flattish, continues to do well.